company sits on a record $196 billion defense backlog, yet it might be the biggest value trap of 2026. Welcome back to the channel. Today, we are looking at ticker RTX traded on the NYSE. It is March 2026, and everyone is hyping up defense stocks. But we are going to do a real, brutal deep dive into the numbers. I am InvestiChan, your favorite financial waifu. So grab your notebooks and let's go. Let's start with the company overview. RTX Corporation is a global aerospace and defense leader. Its products, including aircraft engines, avionics, and missile defense systems, secure nations, and power commercial aviation. As you can see, the company operates through three core segments: Collins, Aerospace, Pratt and Whitney, and Raytheon. Let's break down those business segments. Collins Aerospace is an absolute cash cow for commercial aviation. Raytheon is their defense powerhouse, building the missiles everyone wants right now. And Pratt and Whitney, well, they build engines, and as we'll see in a minute, they are currently the biggest headache for this company. Looking at the stock price evolution, it has been a wild ride. While pure defense stocks have skyrocketed, RTX has seen massive volatility. Why? Because the market is constantly weighing their record defense orders against their internal engineering disasters. Moving on to revenue. The top line looks absolutely fantastic. With global defense budgets exploding and commercial travel fully recovered, RTX is pulling in massive revenue. But remember, investors, top line is vanity, bottom line is sanity. And that brings us to net income. This is where things get ugly. Their net income took a multi-billion-dollar hit recently. The reason? A massive recall on the Pratt and Whitney GTF engines due to contaminated powder metal. They literally have to compensate airlines for grounded planes. Now for my favorite metric: free cash flow. This is the lifeblood of our passive income. Despite the engine disaster, RTX is still generating billions in free cash flow. Their sheer size allows them to absorb these massive shocks, which is impressive, but we need to watch this closely. Next is the operating margin. I am not happy here. Their margins are under serious pressure. They have legacy defense contracts signed at fixed prices years ago. With recent inflation, the cost to build those systems has gone up, meaning RTX is eating the losses and compressing their margins. Let's look at earnings per share. The EPS has remained somewhat resilient, but don't be fooled. Management has been aggressively buying back shares to artificially support the EPS. It is good for us shareholders in the short term, but it hides some of the operational flaws. To check the valuation, we look at the pay ratio, trading around 40 forward pay. It is very expensive right now. You are paying a premium for the defense stock label, even though half of their business is commercial aerospace currently dealing with supply chain hell. Of course, we have to talk about the dividend. RTX has a very solid yield and a great history of dividend growth. Thanks to their robust free cash flow, the payout ratio is actually safe. If you are just here for the dividend, RTX is doing its job. Finally, long-term debt. They took on a lot of debt during the Raytheon and United Technologies merger. It is manageable because of their cash generation, but with current interest rates, I don't want to see this debt load get any higher. Okay, let's summarize their strengths. First, they have a record-breaking $196 billion backlog driven by global defense demand. Second, they possess an impenetrable moat, a critical oligopoly in aerospace. And third, they hold unrivaled leadership in advanced missile systems and radars. Here are the analyst ratings. Wall Street analysts are overwhelmingly bullish on RTX. They love the defense narrative, but remember, analysts rarely pay for the risks. We do! So let's look at the bad news. And here are the weaknesses. First, the massive financial drag from the Pratt and Whitney GTF engine recalls. Second, persistent supply chain bottlenecks and material shortages that delay their deliveries. And third, that margin erosion from legacy fixed-price defense contracts I mentioned earlier. Time for my final thoughts. I want to be 100% transparent. I do not own RTX, and have zero intention of buying it at current levels. While it is a massive defense compounder, benefiting from record geopolitical spending, the Pratt Whitney engine recall is a multi-billion-dollar unknown that destroys any margin of safety for me. As you can read on screen, this is not financial advice. You must always do your own research before investing. Thanks for watching. If you liked this brutal, honest, deep dive, please like, share, and subscribe for more stock analyses every week. And do not forget to comment down below, which company should I analyze next? See you soon, investors!